Howdy, everybody. Welcome to Liberty Call for Tuesday, May 6, 2025. I don't know why I'm out of focus. It's really bothering me. Anyways, hope you're having a great day out there. It is rainy and cold here in Colorado, so that's probably why my image looks so bad. It's so overcast. Anyways, hope you're having a great day out there. Market slid again as the Fed kicked off its policy meeting and Trump threatened new tariffs on pharma. Great. The Dow dropped over 450 points at one point, and Palantir got hammered. DoorDash fumbled a $3.8 billion buyout, and Ford warned tariffs could cost them $1.5 billion. Gold stocks shining bright as investors look for cover. So before we dig into all the news, I need some help from you. If you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All righty. Well, let's hop into the news and the markets. Dow Jones was down 0.95% today, 390 points, closed at 4828. S&P 500 down 0.83%, 46 points, closed at 5603. NASDAQ down 0.87%, 154 points, closed at 17,689. The VIX was up 4.74% today. It's at 2476. Canada up 0.08, Brazil up 0.07, and Mexico up 2.83. Our friends over in Europe, Germany down 0.46%, the UK up 0.01, France down 0.4, the Netherlands down a tenth, Spain up 0.09, Italy up 0.22, Switzerland down 0.07, and Portugal up 0.13. Russian exchanges today in the green, the MOEX up 3.08%, and the RTSI up 4.29. And the overnight markets in Asia, the Nikkei was up, it's closed. Australia down 0.08, New Zealand down 0.15. Looks like the Chinese markets are open. The Shanghai up 1.13%. Shenzhen component up 1.84. China A50 up 0.51. DJ Shanghai up 1.26. Hang Seng up 0.7. And the Taiwan weighted was closed. All right. So those are the markets. Jeez. I don't know why I'm so out of focus today. See my hands in focus. Pulled away. Anyways. All right. And I took that off the screen, which I did not mean to do. All righty. Well, let's jump to the market recap. S&P 500 slips amid lack of U.S.-China trade progress. Fed meeting is looming. Dun, dun, dun. The S&P 500 fell on Tuesday as investors grew cautious due to the absence of concrete developments in U.S.-China trade negotiations and ahead of the Federal Reserve's rate decision expected tomorrow on Wednesday. President Donald Trump stated that China is open to negotiations, but emphasized there was no immediate urgency to strike a deal. Markets briefly rallied after Trump hinted at a, quote, very, very big announcement, end quote, before his Middle East trip, but optimism faded when he clarified that it might not be trade-related. Trump not being honest about something, I'm shocked. Or being, verbose or hyperbolic. All right. Meanwhile, the Federal Reserve began its two-day policy meeting with expectations that interest rates will remain unchanged. Federal Reserve Chair Jerome Powell's post-meeting remarks will closely be scrutinized for clues about the future rate path, especially given inflation concerns and ongoing tariff pressures. Again, looking at the situation, I don't know why the Fed would lower rates. I mean, you could make an argument for raising rates simply because inflation is still kind of sticky, or keeping rates where they are. But lowering rates, there really isn't a good reason unless the economy, craps the bed, or something really unexpected happens, like COVID. Hey, who would have thought that would have just come out of nowhere? Weird. Recent data revealed a stronger than expected services sector performance, although rising input costs raised fears of inflation. The U.S. trade deficit widened significantly in March to $140.5 billion, up 14% from February, as businesses increased imports in anticipation of higher tariffs. Earnings reports also influenced market sentiment. Ford stock rose over 2%, despite cutting full-year guidance due to tariff uncertainty. Palantir fell 13% after missing earnings expectations, while Tesla dropped more than 2% following weak European sales figures. DoorDash plunged over 8% after missing revenue estimates and confirming its acquisition bid for Deliveroo. Mattel rose 3% despite pausing its 2025 guidance, citing tariff-related uncertainty. Toy company, and they probably get a lot of their stuff from overseas. With no breakthroughs on trade and inflation risks mounting, and investor sentiment remained fragile ahead, or fragile if you're Italian, ahead of the Fed's policy update. All right, so there we are there. Good stuff. All right. camera's really bothering me. I know. Well, I mean, if you're just listening, it's probably no big deal. But, anyways, all right. Well, let's get to a data report from First Trust, March International Trade. This was put together by Mr. Strider Elas. So let's see what he had to say here. The U.S. trade deficit surged to a record 140.5 billion in March, driven by a $17.8 billion spike in imports as companies scrambled to front run President Trump's new tariffs. Pharmaceuticals led the surge with a massive $20.9 billion increase in a single month. Because imports subtract from GDP, this spike in inbound goods significantly dragged down growth, shaving nearly 5 percentage points off first quarter GDP and contributing to a 0.3% annualized contraction in Q1. However, the tariff-driven import boom appears to be peaking. Early data suggests a sharp slowdown in shipments from China. TEU 20-foot equivalent unit bookings to the U.S. are down over 40% year over year for the weeks April 14th and 21st, and down 27% for the week of April 28th, according to tracking from Vision. Overall, U.S. trade volume is up 18.1% from a year ago, with exports rising 6.7% and imports jumping 27.1%. Notably, China has dropped to third place among U.S. trade partners behind Mexico and Canada. One more positive note, the U.S. maintained its status as a net exporter of petroleum products for the 34th consecutive month, with petroleum export values once again surpassing imports. I still don't understand why we import oil. I mean, it could be just because we don't have the right grade of crude for whatever purposes are needed, and that'd be a perfectly good explanation. But no one's ever given me a good reason. We got more oil underneath the United States from the East Coast and like the Pennsylvania area. There's in Western New York, lots of oil and gas under the ground there, all across, West Texas up through up to Canada, all through the Great Plains. There's lots of oil reserves there. So, I mean, we're sitting on a ton of value. I mean, the excuse I've heard from one or two people is that, the people who own those rights don't want to deplete them. They want to hold on to them as an asset and bring in oil from other places so that, they can have their cake and eat it too. So, but I don't know if that's, 100% the reason behind it. All right. Next up, got an article here from Zero Hedge. Peter Schiff, don't trust the rebound yet. So if you've been getting that itchy trigger finger to, jump back, with both feet into the markets because, there appears to be back in rally mode, cool your jets, folks. In his latest podcast, Peter Schiff dissects April's unexpected stock market rally, scrutinizes tariff-driven economic optimism, and exposes contradictions in the U.S. currency policy. April began with sharp declines, especially in the NASDAQ, but reversed mid-month, ending with gains as investors interpreted political rhetoric as signs of de-escalation in a trade war. Schiff warns this optimism is misplaced as the actual economic pain from the tariffs has yet to fully hit. He argues the recent market strength is based on the illusion that tariff impacts won't be severe. In reality, many companies front-loaded inventories before tariffs took effect, masking the true economic toll. As these pre-tariff goods sell out and restocking slows, businesses and consumers will feel the full sting. Schiff also calls out the hypocrisy of U.S. current policy. Treasury Secretary Scott Bessent simultaneously criticizes foreign nations for undervaluing their currencies, thus strengthening the dollar, while promoting a strong dollar policy at home. Schiff points out the logistical inconsistency in claiming economic harm from a strong dollar while insisting it's a national policy. Lastly, he highlights the growing influence of money in politics, because there's, that just started now, citing reports of President Trump's son opening a $500,000 membership club for elites seeking access to cabinet officials. Schiff sees this as emblematic of Washington's corrosive culture where wealth buys influence. In closing, Schiff advises cautious investing, not a bad idea, possibly looking abroad, and warns that market participants still underestimate the delayed but inevitable economic consequences of tariffs. Peter's usually really right. I mean, he's a bit of a gold bug, so usually the solution to any of his problems is buy gold. He sells gold for a living, so I understand why that is his number one arsenal in his tool belt. But there are times where gold and silver and precious metals aren't ideal. Now's not necessarily that time. I mean, if the equity and bond markets are going to go to hell, where do you put your money? Well, precious metals isn't the worst idea. So again, not financial advice. Go talk to a financial advisor before you buy anything. But there's only so many places you can stash your cash in. I mean, you can't just leave it in dollars in the bank because of inflation. The Fed continues to increase the money supply. So if you just leave it there, you put $100 in right now, it has the buying power of $95, a year from now. So that's not ideal. All righty. Last up, I got another article also from Zero Hedge. Paul Tudor Jones warns about new market lows, Skynet-style AI threat to humanity. Dun, dun, dun. Kind of like Terminator. Billionaire hedge fund manager Paul Tudor Jones, PTJ, delivered a sobering warning on CNBC's Squawk Box, cautioning that the combination of Trump's aggressive tariffs and a rigid Federal Reserve could drive the stock market to new lows. Well, I think they're going there regardless. I mean, I don't think Trump or the Fed can really stop that. Jones criticizes the administration's 145% tariffs on Chinese goods, noting that even if Trump dials them back to 50%, it would still represent the largest tax increase since the 1960s, potentially shaving 2 to 3% off U.S. economic growth. I know what would help would be reducing the tax burden on the people who actually make a living in this country. And, if you didn't take one of every $3 that successful people make, then, there'd be more money in the economy and, people could use that to, start new businesses, hire new people, whatever, invest into a company that they then hire new people, whatever the case may be. Despite some optimism from Goldman Sachs, who expects tariffs to ease soon, possibly dropping from 160 to 60%, Jones remains bearish. He argued that without significant Fed rate cuts, markets are unlikely to stabilize. Again, he's probably one of those people who believes that interest rates should be kept at or near zero, so because it creates economic expansion. However, you're devaluing the current currency at the benefit of the future equity prices. So just because equity prices go up doesn't mean the buying power of the dollar hasn't changed. Where was I? The recent GDP report showing a negative 0.3% contraction in Q1 adds weight to his outlook. PTJ predicts that only after new market lows will policymakers act. Quote, then we will get some kind of reality, end quote. Current interest rate swaps anticipate 325 basis point rate cuts by year end, with the first expected in July. Beyond economics, Jones also voiced serious concerns about artificial intelligence, claiming there's a 10% chance that AI could kill 50% of humanity within 20 years. Echoing previous warnings from Elon Musk and BCA Research. Strikingly, he placed more emphasis on AI risks than on nuclear war, highlighting what he sees as an underestimated existential threat. Jones's dire outlook combines fears of economic strain from tariff policy with deeper anxieties about AI's impact on humanity, painting a grim near-term picture for both markets and society. Well, that is some awesome news. I'm glad I shared that with everyone. We got less than 20 years before the Terminators kill us all off. So awesome. Well, I'll be old by then. I mean, I'm 51 now. I'd be 71 in 20 years. Yeah, I'm on the downslope at this point, so I'm not that worried about it. Yeah. Maybe my kids and grandkids. All right. Well, that's everything that I had to ramble on about today. So if anyone needs anything from me, where do you go? Wait for it. Oh. DSA Financial Group.com. All your financial planning needs can be addressed there. So give me a jingle. I'd be glad to help you get your stuff together. Almost cussed. Anyways. All right. Well, like I said, hope everyone has a great evening, and hopefully this rain passes in the next couple of days. Seeing a couple snowflakes falling from the sky at the same time, which I don't think it's cold enough for snow, but it must be cold. Well, probably about 10,000 feet higher. It's really, really cold. So anyways. All right. Well, hope everyone out there has a great night, and I'll talk to everyone again next time. Adios.